Hi there, Rich Dickey from Trading with Rich. I'm going to do a short video this morning here. It is Thanksgiving morning, 11/24 on 2022. And what I thought I would do is just kind of talk a little bit about covered calls, cash secure puts, and then leaps, which are also called the poor man's covered call. Okay, so here's one of our portfolios, and I'm going to show you Alibaba. Now, Alibaba is, one of the plays that I'm making, considering the fact that I think that it has been drastically reduced in stock price over the last 2 years because of basically COVID and political rhetoric that's been going on. The company has a fantastic balance sheet. It has a fantastic cash flow. It's buying back its stocks at a high rate, $79. And as of yesterday, which was the day before Thanksgiving, it was $78.50. My average price on these stocks is right about $80. These 900 shares represents $71,000, 904 invested, and it's worth $70,650. So it's down about $1,200. So those are my shares, full shares. And then I've got, it says stock plus 7 options. So on some of the options, you can see down here, see this June 21st with, 575 days left. Well, that is a vertical option, what some may call it a calendar option. I've got 575 days to make a move on this product. Right now, I paid $4,150 to be able to buy this for $65 on June 21st of 575. So we're looking at 2024. On the next one, I bought an option, paid $2,000 on it. You notice how the price went down a lot. That's because I agreed to pay higher for it, but I'm anticipating that it'll be above $120 in 785 days, which is a little over 2 years. So January of what would that be, 2025? I bought a $2,000 option. It's currently worth $1,400. On this one, $4,100. It's currently worth $2,900. Same date, January 17th of 2025. It has an option to be able to buy all these shares at $100. Currently the market's $78.50. I paid $2,800 for it, and it's worth $19.10. Now you might say, why, when you just bought these, and I think I bought these about 3 months ago, why are they down $1,200 and $600 and $980? Well, that's because you've got to pay some intrinsic value to actually have the ability to buy these shares at $65 or $120 or $100. Hopefully your stock is worth more than the $80 that I've got invested. And I won't sell these stocks, these 900 shares up here. I won't sell these until they're way over. I'm hoping that it triples in value and goes up to about 210. I owned a lot of Alibaba when it was 225 and 275. Less than a year and a half ago, right about election time, it was $325. But it's $78.50, so it is what it is. So I'm going to show you how to read making on covered calls. And we'll kind of concentrate here on the 900 shares that I own 100% of. So what have I done? How am I trying to rent my stock out? That's what a covered call is. You own the stock and then you rent it out. You offer to someone on the other end the opportunity to buy the stock from you at a higher price. So what I did was this first one, I put 2 contracts out there. The contract is 100 shares of stock. So this is 200 shares of stock. And I said, I'll offer it to you, the trader on the other end who's buying this option, and covered calls are an option for this person to buy this stock at $88 on November 25th. Now it's November 24th now. If it goes up to $87.99, I'll get to keep this stock, because most people are not going to go out there and buy it from me at $88 when they could get it cheaper at $87. They'll just go ahead and buy it off the market. So if they did, and I have had this happen once, maybe in the last 3.5 years, somebody actually did buy the stock from me at a higher amount that was in the market. Well, that's fine. Go ahead and buy it, and then I'll repurchase it at the lower amount. But I think that was a mistake that the trader made on the other end. So what have I done to make money here? Well, I offered to sell my stock at $88 on November 25th here, 2 contracts, and I offered $220. I could offer to get out of it, and it would only cost me $4. So I would end up making $220. Well, I'm just going to go ahead and let this go through tomorrow, and on two contracts at $4, I could buy myself out of it and relieve myself of the obligation of having to hold these stocks for the other trader. I could go ahead and pay the $2 and let that person, make my $2 times 2, and they collect $4 from me. But I'm not going to do that. I'm going to go ahead and just let it expire. And when it expires, then this contract goes away, and I keep all $224. Now, what you can't see here is that I did this particular one about 10 days out. So I made $224 in 10 days. Now, on this December 2nd, I've got 10. Contract would be 10 times 100 is 1,000. And it's my POP. I got 7% chance of making profit on this. So that's the percentage of profit that they estimate you may make. And they're saying you're probably going to make, there's a 97% chance, which is a very high chance that you're going to make all the money on this. So anyway, I put out 1,000 shares, said you could buy it from me for $90, but it'll cost you $1,304. And you need to know how to do this through your brokerage firm, and this is Tastyworks, which are fantastic people. I've been with Tastyworks, this particular brokerage, for about 4 years, and I love these people. They're really good, very low commissions, and they'll answer any questions you have when you call in. The help and customer service is fantastic. But their platform tells you how many days. I've got 8 days to go before this obligation expires. So what is the obligation? Well, it's a $90 call, and currently the prices are at $78.50. When I made this, it was actually $84.50. The price was $84.50. It's gone down a little bit since I made this, which was a 2-week call. So I wrote it out with 14 days. 6 days have already expired. The price went down a little bit. When the price goes down, it makes your ability to make the suggested or the contracted price of $1,300 makes it a lot more likely that that's going to happen. So they're estimating on these 10 contracts that I could get out of this obligation for about $265, which evenly divided number, that's only $26.50 per contract. And I could just get out of it tomorrow and make $1,039 and be done. But I don't want to give back that $265. I've only got 8 days to go. I got a little over a week where I could go ahead and replace that $265 into the $1,300. Now, when you look at how much I have invested in Alibaba, it's $79,290. It's currently worth $76,000. Why is it? Where's the difference here? The 1,200 on the 900 shares. Well, it's these 3 leaps that I have down here. All right. So basically, I did this one for 10 days. I did this one for 14 days. I made 20. I'm going to make 224 by tomorrow. I'm obligated to go ahead and sell my 1,000 shares. Let's say it goes to $92. I'm obligated to sell it to that person for $90. If it goes to $95, I'm obligated to sell it for $90. So there is a a limit to the amount of profit you can make when you do a call, because you're actually saying, I'll rent out this house, but when it gets to be over $100,000, no matter how high it goes, 105 or 110, I'll let you have it for $100,000. And that is what a covered call is all about. As simple as that. And so that's 12 contracts. I have 900 shares that I own outright, and I have 300 shares that I have on leaps. And that's pretty normal. If you can do 3% every 2 weeks and do that, 26 times, you're looking at 3 times 20, 3% times 20, 26. That's pretty healthy. That's a very healthy return on your investment. But when you're looking at over 50% returns, that is helping. Like this $1,500 that I just am making on this particular one here over the next, over 2 weeks, that $1,500 is knocking out what I have down here for the extra premiums that I paid to be able to buy these shares further into the future. So instead of doing 2 weeks out there like somebody else is doing here when they're buying it from me, I'm doing it, 2.25 years out. So I'm doing it 785 days out. I have said I will buy this for $120, but I will pay you $2,030 to be able to buy this, 100 shares at 120. Well, 100 shares at 120 is, $12,000. I only paid $2,000. I paid $2,000 because I feel like it is going to go over the 120, but I could lose that whole $2,000 if it doesn't get to 120 by January 17th of 2025. I could lose that all. So in the meantime, I use that to go ahead and do a cover call. So these 3 are part of the 9 up here, and I'm averaging $1,500 a week, so it doesn't take very long. Now, I'm going to have those leaps for over 2 years, 785 days, and unless I have to sell those shares, at the current going price, I can easily cover what I've invested in those leaps. On the 900 shares, if this thing were to go to $90, fantastic. I'll let them go. If they go to $90, I'll let 1,000 shares go. And what does that mean? Well, 90 times 1,000. How much is that going to go up? It's going to go up $9,000. So instead of being worth $70,000, it'll be worth right about $80,000, and I have $71,000 invested. And I haven't let one go in this whole year. In 2022, I have not had any of my shares go over the price. Now, part of that's because the stock market's been crazy, and it seems like everything just keeps going down. You just have to be able to, ride out the storm, wait for your shares to come back up. The other part of the covered call is that when your stocks do get to be, say, 25% of their original value, you don't want to be trying to sell those back to somebody at a price that's way underwater. So that's a whole nother topic and a whole nother video. So this is a cash secured put. And on December 2nd, 8 days from now, I've got 4 contracts out there where I've agreed to $68. Now, if it drops below $66, I put insurance on that. So that's the limit I'm going to go. I'm going to actually own these shares at 66 and pay 68, so about $200. So basically, when I bought it, I sold the opportunity to buy those shares at 68 for $452, and then I paid insurance at 66 on the put, and so overall I can make $120 on this. I'm doing that every 2 weeks. I'm picking out a price that I think I could live with. Do I think it's going to go down to 66? The probability of that, as what this is saying, is nope, probably not. 97% chance that that's not going to go down to 78. That's a cash secured put. So you've got stocks you own, a covered call at $88, going to make $224 on that. A covered call at $90, I'm going to make $1,300 on that. a cash secured put that I put up about triple the amount of money that I put into this. So I put in, I'm going to make $120 or 120, yeah, $126. I'm going to make $126 on this, but I had to put some cash up. It wasn't free. You couldn't just go out there and do it. I put up about 1/3, so I had triple that. So the 126 times 3, I put up about 388. I could get out of it for 304. I could end up just saying, I'm done, let's close it tomorrow and make my $84. Or I could go ahead and keep it till next Friday and try to make the whole amount, which is the 126, which is what I'm going to do, because I don't feel like it's going to go to 60, 68. I know that was a lot to cover, but this is a good example on how to do covered calls on your 900 shares of stock, covered calls on your 300 shares of leaps, which are now called poor man's covered call, putting covered calls on an option. It's also called a synthetic option. And then I did a cash secured put. So what am I making in 2 weeks? The 1,500 plus the 126. And what do I have invested? $76,000. So if I made, let's just call it, instead of 1,600, let's just call it 1,500 every 2 weeks, which is very easy to do. That would be $3,000 a month, and there's 13 periods when you take 4 weeks into 52. So take 13 times 3. You're making $39,000 a year on covered calls on an investment of 76. Not too bad, not too shabby. And where's all the risk? Well, the risk is you own the stock. Well, if you're going to own the stock anyway, you might as well rent it out and let other people play options on your stock and be the bank. Be the one that actually owns the stock and rents it out. And trust me, it's not hard to rent it out at these prices. A couple times, then you agree to a price and you're done. Now you have that obligation until the date that you set for your price. And for me, it's 88 by tomorrow, and it's 90 by next Friday. So that's how you do covered calls, cash secured puts, and long expiration anticipated products, and use those for a covered call. So 900 and 300 are 1,200. I got 2 there and I got 10 there. So I hope this was informative, an actual live account, and where it sits today, November 24th, Thanksgiving of 2022. This is Rich Dickey from Trading with Rich. You're on my YouTube channel, and I'm trying to share products with you so that you can actually learn how to do these. Thank you, and I'll see you on the next video.